Many people say that the Federal Reserve is behind the curve. In other words, the inflation genie's out of the bottle and Jerome Powell and the Fed can't get it back in. So in this video, we'll look at their policy choices, we'll look at exactly what they can and can't control, but also where rates are going to end up in this rate hike cycle, according to the Fed, but also according to markets. So let's look at the Fed versus inflation in a bit more detail. The worry at the moment is that the Federal Reserve is going to crash the US economy by raising interest rates too sharply. And if we look at strategists at investment banks, opinion seems to be split roughly 50-50, with Deutsche Bank being the most bearish. Here they're saying that it's likely that the Fed's going to have to step on the brakes even more firmly, in other words, tighten monetary policy really rapidly, and that that's going to create a deeper recession to bring inflation to heel. And then at the other end of the spectrum, Bank of America thinks that inflation's going to peak this year, in fact this quarter, and that it's going to fall steadily into 2023. And in fact, they think now would be a good time to buy 10-year treasuries, because they think yields have currently peaked. Now the key thing to watch is how tight financial conditions are in the United States. Now that's not only controlled by the central bank. If you look at things like the credit market, but also things like money market rates, that also affects financial conditions, and all of that isn't under the Fed's control. Now, this indicator from the Chicago Fed is called the National Financial Conditions Index, and when it's high, as you can see on this graph, conditions are tight. That's generally bad for the stock market, but at the moment, you can see it's negative, which means that conditions are very easy. However, if you look at the recent conditions index, you can see that things are tightening. And that's even before the Fed's really started to raise interest rates and shrink its balance sheet. But this is a key indicator to watch because it tells you what the overall financial conditions are, as well as what the Federal Reserve's doing. So what can the Fed do to get the inflation genie back into the bottle? The state of the US economy right now is one in which unemployment is extremely low. It's at the lowest it's been for decades, in fact. And that means we've got a very tight labour market. There are lots of job openings, and it's very easy for people to find new work, and it's hard for employers to find people to fill roles. And that situation is one in which you typically get very rapid wage growth. So the way that the Fed would counteract that is to raise interest rates and hopefully reduce demand for goods and services. So the very fine line which the Fed treads is that they don't want to cause a deep recession, but they do want higher unemployment, because that means that there'll be greater labour market slack and that there'll be slower wage growth. Because the worst that can happen is that we get a price-wage spiral where prices chase wages and wages chase prices. However, a lot of the components of inflation which have caused it to surge upwards are not directly under the Fed's control. These are exogenous factors, things like the price of oil. The Fed can raise interest rates, but that's not going to drop the price of crude. And we have seen some staggering increases year on year. For example, if you look at fuel oil in the United States, that was up 70% year on year in the March print of inflation. And the other components which have surged were things due to a lack of supply. So there was a supply-demand imbalance as people went back to normal behavior after the pandemic, created a surge in demand, and then supply simply couldn't meet it. For example, the chip shortage caused this surge in used cars and truck prices. Again, that's not something which the Federal Reserve can control. If we decompose the 8.6% increase in inflation year on year that we saw in March into its components, you can see the biggest component was due to that factor which the Fed can't control, which is energy. That's why transportation costs increased so much year on year. In fact, that was half of the increase that we saw in March. Then we get to the first factor which the Fed can control, which is housing. Because there, if we look at the cost of funding a mortgage, that's dependent on the Fed's policy rate. And there we have seen rates increasing very rapidly if we look at the 30-year cost of a fixed rate mortgage. So at least that component is under the Fed's control. And then we get to the price-wage spiral, and this is what the Fed is really worried about. So in this top panel, you can see how many unfilled job vacancies there are per unemployed person. And currently that's the highest it's been for over 2 decades. So there are roughly 2 unfilled job vacancies for every unemployed person. Now in Fed parlance, that's called a very tight labour market. And typically, economic theory would tell us that that would be a cause of very rapid inflation increases. Now, the last time labour markets were this tight, there wasn't a big increase in inflation. That's what you can see in this bottom panel. So really, the Fed is kind of staving off the possibility that we're going to see a price wage spiral, even though there wasn't a lot of evidence that that was causing inflation before the pandemic. And if we look at earnings growth in the United States, that's the blue line you can see on this graph, and we compare that with inflation, you can see that both have been going up recently, with wages growing faster than they have for over a decade. Wage growth is about 5.6%. That was the latest number we saw, whereas inflation, as we said, is 8.6%. So certainly for now, it's not looking as if wages are yet successfully chasing prices higher. This was Jerome Powell's response to a question which said, how does the Federal Reserve's raising interest rates reduce demand without raising unemployment rates?
What you have is 1.7 plus job openings for every unemployed person. So that's a very, very tight labor market, tight to an unhealthy level, I would say. So if you were just moving down the number of job openings so that they were more like 1-to-1, you would have less upward pressure on wages. You would have a lot less of a labor shortage, which is going on pretty much across the economy. We're hearing from companies that they can't hire enough people. They're having a hard time hiring. Basically, across the economy, we'd like to slow demand so that it's better aligned with supply, give supply at the same time to recover, and get into a better alignment of supply and demand, and that over time should bring inflation down. Of course, the plan is to restore price stability while also sustaining a strong labor market. That is our intention, and we believe we can do that. But we have to restore price stability.
So Jerome certainly thinks that the Fed can control inflation, but what do markets think? Well, beneath me here, you can see the probabilities which are priced into the market. This is taken from the CME FedWatch tool produced by the Chicago Mercantile Exchange. The dates you can see in the column beneath me are when the FOMC is going to meet. So the next meeting, as I make this video, will be in May 2022. Then these numbers along the top are the policy rate in basis points. The blue box here shows you the most likely policy rate according to the Fed Funds Futures market, which is between 0.75% and 1%. So that's 0.5% above where we are today, because usually the Fed raises interest rates in steps of 0.25%. So this is a 2-notch increase. But then we have a 3-notch increase between then and the June meeting of the FOMC. So this is really the Fed slamming on the brakes. Then we get a 0.5% increase for the July meeting. And then finally, we get to the normal steps, which is 0.25%. And that happens for 1, 2, 3, 4 meetings. And that brings us to the beginning of 2023. And only then does the Fed start to stop its rate increases. So really, this is the Fed slamming on the brakes for much of 2022, particularly at the beginning of the year. Now, wouldn't it be great if you had a video of me explaining how this FedWatch tool worked? Because then you could use it for yourself. Well, if you're a member, that's exactly what you get. Members asked for this, and I created a video which explains exactly how to use it. So don't forget that if you do join our membership, which we now run on our website, PensionCraft.com, you get access to this and all kinds of other goodies. Lots of other members-only videos, plus access to Slack, so you can chat to me and other members of the community anytime you like. To learn more about that, just click on the link beside me and in the description beneath me. Now, it's also interesting to see how those probabilities change over time, and that's what you can see in these 4 panels. The top panel shows you the probability of no rate hike at all, which you can see for much of the last year was what markets were assuming. Then as inflation started to spike towards the end of 2021, you can see the probability of the Fed doing nothing falls essentially to 0. Then the probability of 1 rate hike increases, the probability of 2 rate hikes increase after that. And as we already saw, currently what we're seeing is that the 75 to 100 basis point policy rate is the most likely outcome. So it's always useful to look at this FedWatch tool to see how these probabilities are changing over time. And if we look at the expected policy rate for the end of 2022, you can see that the most likely outcome is a rate between 2.75% and 3%. So that's 2.5% above where we are today. So this is a lot of rate hikes, and I suspect that the equity market is going to find that quite difficult to digest. And the bond market and the equity market are telling you quite different stories at the moment. If we look at bond yields in the US, you can see the 1-year, the 2-year, and the 30-year yields here since the Fed cut policy rate to zero effectively up to the latest yields today. And you can see the 1-year rate, which is pretty much the policy rate, is currently just below 2%. So certainly the bond markets have pretty much capitulated and priced in much of this rate hike cycle already. Equity markets are still pretty much going on as if everything is okay. We have seen some sell-offs, but it hasn't been particularly severe. The other major policy tool that the Fed has is that it can shrink the size of its balance sheet, or start balance sheet runoff as it's called. This top panel shows you the size of the Fed's balance sheet in trillions of dollars. Currently, it's almost reached $9 trillion. But the reason why I showed this was to show the last time the Fed started to shrink its balance sheet. It doesn't actually sell treasuries and mortgage-backed securities, which it's holding. Instead, it simply stops reinvesting the coupons as they come due and the principal payments as they come due. Because the point about bonds is that they mature. You don't have to sell them, you just wait until you get your money back. And here you can see the last time it started runoff, and very gradually the size of the balance sheet started to shrink. But the noticeable change this time around is that instead of having a 2-year lag between raising interest rates and starting balance sheet runoff, this time around it started the first rate hike in March and is looking very likely that runoff will start just one meeting later. So that's just 2 months after the first rate hike. So if we're going to use the brake analogy, it looks like this time around, the Fed is slamming on the brakes and pulling on the handbrake at the same time. So when will these rate hikes actually stop? Well, we can look at that question in 2 ways. One is to look at what the Federal Reserve is telling us. They have a summary of economic projections where each of the FOMC members puts a dot on this chart saying where they think rates will be in 2022, 3, 4, and over the longer run. The blue dots show their median projection. So that's what the FOMC kind of expects. And that's a rate for 2022 at the end of the year, which is just under 2%. And remember that the current 1-year yield on US Treasuries is roughly there already. If we look at the Fed Funds futures market, that's pricing in a higher rate. So that's expecting around 2.75% by the end of this year. So certainly at the moment, the Fed is kind of behind where the market says it's going to be by the end of the year. If we look in 2023, similarly, the market expects rates to be higher than the FOMC, although the difference is smaller. And then at the end of 2024, the two are pretty much in line with each other. Rates are expected to be just over 2.5%. But if we were to come up with a really simple heuristic for when the Fed stops raising interest rates, it's when something breaks. Which is why I love this tweet from Jim Bianco, where he gives examples of the 10-year yield falling whenever something does break historically. So recently, that was the last time the Fed started its balance sheet runoff. Then there was an accident in EM in 2013. Then between 2009 and 2010, we had the sovereign debt crisis in Europe. So every time there's some kind of accident induced by the Fed, that's when interest rates start to fall again. And I'm sure that's what will happen again this time around. So it's very clear that the Fed is now fully committed to using all of its tools to stopping that price-wage spiral becoming entrenched and keeping inflation high for a long period of time. That also means that the Fed put, which is what people call the Fed rushing to the rescue every time equity markets fell, that's pretty much gone until the Fed gets the inflation genie firmly back in the bottle. So remember our offer, our membership offer, which we now run off our website, PensionCraft.com. You can learn more about that by clicking on the link beside me and in the description beneath me. And as always, thank you for listening.